Live from New York City this morning. Good morning, good morning. 3 weeks of gains on the S&P 500. Can we make it 4? Payrolls on Friday and some tech earnings later this week. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York, coming up, tech heavyweights reporting earnings this week. The US payrolls report just around the corner. And first into the hiking cycle, first out. We begin with the big issue, strategic ambiguity.
The strategic ambiguity.
Strategic ambiguity.
We've got to pay attention to central banks.
Bank of Japan was the last one holding.
This is a really small tweak.
Small tweak.
There is no actual line in the sand.
The first signal that they're going to start tightening policy.
The trajectory is towards tightening in comprehensive conditions.
They have this last mover advantage.
Every BOJ meeting is probably going to be live up ahead.
They're looking to do something different.
It's about the next step.
What comes next?
Central banks have had difficulty forecasting where we're heading.
If the economy stays strong,
central banks might be forced to do more.
Whether it's Powell or it's Lagarde at the ECB.
Everything is on the table.
Central banks are still keeping the door wide open.
Joining us now to discuss, Franklin Templeton, Sonal Desai, Jim Bianco of Bianco Research. Great to catch up with you both going into the opening bow, going into a busy trading week. Sonal, I've got to start with you. A lack of clarity from the ECB, a lack of clarity from the Federal Reserve, a lack of clarity from the BOJ. Some people might say it's by design. Is it a good thing?
It is a good thing. Maybe it's time for markets to stop looking to try and anticipate different central banks' next moves and start focusing more on the data. Look, Jonathan, we've had an enormous number of hikes and the economy keeps chugging along. I think this is not pointing towards an economy under threat from central bank hikes, as everyone anticipated. It is an economy which needs to get used, and a market which needs to get used to the new level of central bank rates, which is substantially higher than where we were for the last 15 years, say.
Jim, is the hand-holding over?
I think it is over, and it should be over. I think that part of what you're seeing with this strategic ambiguity with central banks is a bit political, and what I mean is there's no agreement within the boardrooms of these central banks about what they should do next, even though the Fed wants you to believe this with 11-0 votes. And ultimately, they're trying to figure out what their next move is going to be. And I think it comes down to inflation. Is the inflation rate bottoming this summer, and is it going to start up? Or is the inflation rate going to continue to head lower? And that will probably be the main driver of what comes next.
Well, Jim, we know what you think. You think it picks back up, don't you?
I do. I think that we're at the low on a year-over-year basis now. And it's the base effect. If you look at last July, it was 0, was the inflation rate, was 0.2 in August. With just the jump in gasoline prices in the last week or two, we should easily jump over that. We should be looking at 3.4, 3.5 on the year-over-year inflation rate by, say, Labor Day, if not into October. And that should be enough to at least get the Fed to consider more rate hikes.
So, Noel, where are you on that? The prospect of inflation picking back up later this year?
I think I actually have a lot of sympathy with that view on headline rates. But what I will say is I just don't see core inflation coming substantially below, say, 4.5% as we get to year end. And that's why I actually think additional Fed rate hikes are definitely still on the table. I don't think we can rule it out.
Is there any evidence, Sonal, from your perspective, that we are sufficiently restrictive? When you hear the Fed chair talk about getting to restrictive levels and keeping them those rates there for longer, do you even think they're there yet?
Honestly, I would argue it's not so clear. Look, for right up to the pandemic, if we look at that entire period, we've had real rates of about 0.5%, and there's a lot of people who believe that neutral Fed funds rate, nominal rate, is around 2.5%. So a 0.5% real rate if inflation was as low as 2%. For over 50 or 60 years before the global financial crisis, that number was closer to 2.5, which would mean that nominal Fed funds at neutral would be around 4.5. So we are at Fed funds of around 5.5 right now, while inflation is substantially above where the Fed wants it to be. Are we sufficiently restrictive? I'd argue it's at least debatable. And I'm not so sure that we're not going to see changes to the Fed's long-term SEPs on where they see Fed funds going forward.
Jim,
sorry.
That's all right. Jim, would you agree with that?
Yes, I would agree with that. I mean, people have looked at the 500 basis point rise in interest rates over the last 15 or 16 months and said, wow, that's a lot, and that has to hurt, and that has to have some kind of impact. But what if the vast majority of that rise has just been to keep pace with neutral? And therefore, the amount of restrictiveness that we've put into the system is not that great. And you could see that with the talk that maybe we're going to achieve the soft landing. The economy is not going to have a recession as we move forward. And that's because even though that's been a big rise in interest rates, it's not that far above neutral, and that might give the Fed room to move more should they feel it's necessary in the coming months or year.
25 minutes out from the open and Bal equities at the moment, positive by 0.2%. Lots to talk about with the BOJ, still digesting last week's central bank decisions. Mike McKee has more. Morning, Mike.
Morning, John. Well, I thought I'd start this off with a couple of quotes for you, and I think I did it wrong because it might have been more fun if I didn't put the names on them, and you could guess who said what. In September, there could be a further hike of the policy rate or perhaps a pause. We're in an environment of uncertainty, and we'll reassess the situation and our action on a meeting-by-meeting basis. That was, of course, Christine Lagarde in Le Figaro today. But it was just a week ago that you had Jerome Powell saying it is certainly possible we would raise funds again at the September meeting if the data warranted. And I would also say it's possible that we would choose to hold steady at that meeting. We're going to be making careful assessments, as I said, meeting by meeting. Twin sons of different mothers, except one's a daughter and one's a son, but basically the same message for everybody. And you can see what's happened over the last couple of weeks. You've got the terminal rate, the highest rate that the market thinks these people are going to reach, going up, going up, going up, and then flattening out, because the volatility has dropped out of it since nobody really knows which way they're going. And for either central bank, it isn't much of a move. Now, to get back to what John started with, the Japanese central bank is in a completely different position. They, on Friday, and you can see what happened, they raised the band for buying and intervening in the 10-year yield curve control, and yields went way up. And then this morning, they breached the 60 basis point level, and the bank stepped in to push them back down again below that. They say they are not getting ready to end yield curve control, but the market doesn't think so, and they're testing them. And the reason this all matters, of course, is if the Japanese yields start rising significantly, like the rest of the world, then money will flow back to Japan, out of the U.S., out of Europe, and that will have an impact on markets and rates here. So everybody keeping an eye on the Japanese. They're the ones who are not doing strategic ambiguity now, but the market thinks they are.
Lack of clarity around the thresholds there, Mike. Did you sense it was the pace of the move from Friday or the level of the threshold, 0.6%?
My guess it was a little bit of the pace of the move, because they want to tell the markets, don't test us. We're going to come in if you get too far ahead of yourself.
Mike McKee, thank you. Jim Bianco, I want to come to you on this. We still have yield curve control, kinda. There's a target rate with a ceiling of 0.5. At least they've told us it's not going to be a rigid ceiling. They might let it go beyond, but they will come into the market every single day and buy at 1% if they need to. Then they step into the market at 0.6%, Jim, and we're all scratching our heads. What is the policy? What's the policy, Jim?
We don't know what the policy is. You're right that the 0.5% has now become a reference point. It's not become a ceiling, whatever a reference point means versus a ceiling at this point. I think the Bank of Japan is kind of stuck. They've had this yield curve control policy since 2016. We've completely lost the narrative on it. Remember, the target is 0. And then they just keep expanding the band, and the upper end of the band becomes kind of the new target. So that's what I mean by that they've lost the narrative on it. And so they're trying to figure out what to do with it next. And they're also afraid a little bit about letting it go because of the amount of indebtedness that the Japanese economy has, that if the interest rates were to start to really shoot up, it could have a big impact. And just to reiterate something Mike McKee said, too, let's not forget that the Japanese are the largest owner of U.S. treasuries in the world, more than China. And if their rates become competitive with U.S. rates or the rest of the world, and money flows right back into Japan, then you could definitely see it coming out of U.S. Treasuries, and that would be a net negative for the U.S. market.
Let's build on that. So I'd love your thoughts on it. There are vulnerable parts of this bond market with a big presence of Japanese investors. How vulnerable are those parts of fixed income?
I think that, honestly, this is a part of the reason that I have been arguing for a while now that U.S. 10-year yields are on their way up. This is one element of it, but even without the Japanese, and I get it, it's constructive ambiguity, but I totally agree with Mike McKee. It's a lot more to do with the pace of that 10 basis point move rather than the direction. I think they do have inflation. It looks very much like they might sustainably get their inflation target for the first time in almost 4 decades. And so I think we need to be prepared for Japan being the last to the party, but coming to that party, and probably sometime, maybe next year, beginning to think in terms of raising rates. And absolutely, it has an impact on US Treasuries, especially if the Fed is not in a position to start cutting. And I don't think it's going to be in a position to start cutting soon. It's going to be into next year before we can even start thinking about rate cuts.
It's taken a long time to get to that party. Sonal Desai, Jim Bianco, you guys are really sticking with us. This quote from Governor Kuroda, I'll give you the date on it in a moment, if you missed this. This is from minutes from a meeting a long time ago. We should avoid deploying our firepower in incremental steps and aim to achieve the target at the earliest possible time. Specifically, I have about 2 years in mind. 2 years in mind. To get inflation back to where they wanted it to be, to do all that easing. That quote was from Governor Kuroda of the BOJ back in April 2013, more than 10 years ago. And as Sonal pointed out, we've been doing this over in Japan now for decades, trying to figure it out. You see it in dollar yen this morning, weaker Japanese yen as the BOJ steps back in. Dollar yen at the moment, 142.43. Let's get you some movers going into the opening bell. Here's Abby.
John, let's start with the shares of SoFi, because after a very choppy pre-market morning, we do actually have the stock rising significantly at this point after the online bank raised its revenue guidance for the year, citing benefits from deposit growth and lower funding costs on loans. Right now, up 13%. Palantir also up sharply, up nearly 6%. I suspect this has something to do with tech bull Dan Ives last week initiating on the stock with an outperform rating and a $25 price target, suggesting that more than 20% upside potential is available from here, plus AI being attached to this name. And then finally, to the downside, Ford, Jefferies has cut their view to a hold. They see a worse than expected losses on electric vehicles. It's interesting, into today, the stock up about 20%, the same as the S&P 500, so basically performing as is. But it looks like today Ford is set to take a dip, John.
Abby, thank you. More on that call a little bit later in the programme. Coming up, first into the hiking cycle, first out.
We think the big opportunity right now for the next 6 to 12, 18 months is in emerging market equities and commodities. Emerging markets are going to lead the next cycle in central banks, which is rate cutting, right? We're at the end of the rate hiking cycle in the West.
In EM, the rate cuts are here. That conversation up next.
The signs of deflation are not there in China. What concerns me more is that of a deep recession in China that might have impacts on the stability of the regime, on the stability and constancy of economic policy. The problem with their growth engine is that they've run out of really lucrative investment projects, and that's causing their growth rate to slow down.
It's Carl Weinberg of High Frequency Economics, the latest there on China. Elsewhere, the first to hike, the first to cut. As the Fed and the ECB gear up to hit pause, EM central banks are gearing up to reduce interest rates. Latin America shifting to looser policy, with Chile delivering a 100 basis point cut. Brazil expected to follow later this week. This as China is looking to stimulate its economy by removing consumption restrictions. Equities across emerging markets are threatening to break out. Damien Sasser of Bloomberg Intelligence joins us now. Damien, these were the original front loaders. They got out there first, and we're starting to see the cuts already.
That's exactly right. Well, I mean, it's because their economies are weakening, Jonathan. That's the real story here. It's not so much that, they can cut. And believe me, in Brazil at 13.75%, that's the Selic rate now. They've got plenty of room to cut, but it's the fact that their economies are just not growing. So this is where the rubber meets the road. So I'm not an EM equity guy, but with response to the commodities and EM equities, which are typically late cycle bets, It's interesting to hear some of the other guests talking about how that's going to lead us out of where we are, and it's going to be the beginning of the news cycle. I don't know if I'm so convinced of that, but EM equities certainly, on a valuation perspective, appear relatively cheap to their DM counterparts.
Damien, just how much progress have they made on the inflation story in the places like Chile, where we've had a cut, Brazil, where we're likely to get one later this week?
So Latin America's made a lot of progress. It's Eastern Europe which really concerns me. Hungary's already started the cycle. We're starting to see inflation come off in the periphery. I'm talking Poland, the Czech Republic, but it doesn't seem like those central banks are so willing to cut. In Chile and Brazil, they certainly are. They've gone a long way. And so, yeah, you know, it remains to be seen. My focus is going to be more on the Asian high yielders, Indonesia, India, and the like. They have room to cut, and their economies are weakening pretty significantly also. I mean, and certainly you mentioned China. You know, if China continues to kind of fall off a cliff here, you know, that's not going to be good for the Southeast Asian bloc. And so, yeah, I'm going to be looking at those economies very closely.
Damon, I'm calling the situation in China a shift in posture. It's an easing posture. They're saying the right things. They're going to start to do those things. You're going to see big moves out of that country.
I mean, Jonathan, we've been waiting for Godot for so long, and it really isn't about the supply side. I mean, Jonathan, I'll give you a stat for you. Their fiscal deficit to GDP is actually shrinking. So all the talk about extending restaurant hours, you know, removing restrictions on second car buying, all the things they're doing on the property sector, if they can't still demand, then we have a big problem here. So, you know, we're hoping that stimulus, we're hoping that rate cuts are going to do it. But without putting cash in the hands of households, you know, the verdict is still out.
Do you remember when we used to talk about global synchronized growth? Do you remember that? Everything was synchronized. What about now? How unsynchronized is this policy cycle from EM to DM?
And it's all about interest rate parity. It's all about interest rate differentials. It's all about everything we've talked about with the yen and the carry trade. I mean, you look at Brazil, you look at Chile, you look at these double-digit yielding economies, and you say, wow, I can carry so well in them, and especially on a volatility-adjusted basis now with the VIX coming off. So, you know, I can see I can see the value there. I can see the attraction there. But there are some real problems that are facing these economies, and you rightly point out China. China's now a funding currency, right? The China yuan is now used to fund taking risks in places like Brazil. It was the other way around not long ago, and so this is the paradigm we now live in.
Damien, thank you, sir. Back with us for some final thoughts. Sonal Desai, Jim Bianco. Sonal, it wasn't so long ago we were talking about China reopening. That economy was going to do wonders this year and support global growth, particularly in places like Europe. It's the end of July and we're talking about easing. What does that tell you?
Well, I think there was too much expected from China. It's been slower, but I'm probably not quite as pessimistic. I'm not an equities person, but I'm looking at from the fixed income side. I do think precisely because China's running a relatively small fiscal deficit, there is room for them to ease. That's a big deal. And by the way, that's true globally for emerging markets, not every single one, clearly, but emerging markets in general simply did not loosen their purse strings as much as developed markets did. So there is scope to actually assist on the growth cycle in EM, not just from monetary, but to some extent from fiscal, which DM don't have. So I would say I wouldn't be throwing in the towel on China yet. I still think that as they get a little bit of support off the ground, the rest of Asia stands to benefit from this particularly.
Jim Bianco, do you think the policy mix is more favourable in emerging markets right now?
Well, it is more favorable because, as Damien said, you know, their economies are weakening and they're trying to respond to it, and they're already starting with double-digit interest rates. But of course, when you talk about emerging markets, the biggest one is China, and I'm a bit more pessimistic about China. Just, Jonathan, what you pointed out a minute ago is in January, they did probably the biggest stimulus in the history of China. They ended zero COVID and sent hundreds of millions of people back to work, and that didn't do it. And I don't know if extending restaurant hours and cutting interest rates a little bit is going to really matter at this point if what you did in January did not really get the economy going. And so China is definitely going to lead that emerging market slowdown that we've seen. And I suspect you will continue to see those rates in emerging markets continue to get cut as we go forward.
Jim, are we seeing the early signs in China specifically of the country grappling with a balance sheet recession?
I think we are. I think we're seeing it dealing with a lot of issues, not only with a balance sheet recession, of course, the property market is still in trouble, but also in trying to figure out where China's going to go next, where they're going to lead, where they're going to follow. They're kind of in a flux and in a transition, and it is showing up in their economic growth.
Big one-week gain on Chinese equities, Jim. You just wonder then how much longer that can last.
Yeah, but you also keep in mind that the big one-week gain has come after many, many months of their stock market struggling. So their stock market is at a much higher volatility level, and it's hard to say whether or not that gain has been driven by some kind of reassessment about their future, or if it was just an oversold bounce.
Under the radar, there's been this rally in commodities as well, looking at Brent crude back to about 86. WTI up to 81. So, Noel, how closely are you looking at that right now, and what kind of signal are you taking away from it?
I think I'm taking away that same signal, which is that everyone anticipated a significant slowdown on the back of developed world hiking, and instead it hasn't happened. And now we're at the cusp of emerging markets beginning to cut and start re-stimulating their economies. So it doesn't surprise me that much that we're seeing crude respond to that growth simply hasn't slowed down the way people were anticipating even a few months ago.
So, Noel Desai, Jim Bianco, to both of you, thank you. To set us up for the trading week still ahead, going into payrolls on Friday, 200K the estimate, by the way, and going into earnings on Thursday from Amazon and Apple. At the moment on the S&P 500, about 7 minutes away from the opening bell, equities positive by 0.2%. Coming up in the morning calls and later, Citigroup's Stuart Kaiser making a case for sticking with big tech ahead of those results from Apple and Amazon later on in the week. That conversation up next. 5 minutes away from the opening bell. Equities positive here by 0.2% on the S&P. On the Nasdaq right now, up by 0.1. 3 weeks of gains on the S&P 500. Last week, a decent week of gains. The outperformance, though, a comeback for the Nasdaq. The Nasdaq 100 last week up 2%. That's the price action. Here's some morning calls. First up, Goldman upgrading Chevron to buy 187 price target, highlighting the stock's attractive valuation and improving free cash flow. Next up, Piper Sandler upgrading Wayfair to overweight, pointing to strengthening traffic trends and ongoing market share gains. And finally, Oppenheimer downgrading General Electric to market perform, seeing limited upside following the stock's monster rally so far this year. That stock is positive by 0.3%. Coming up, Apple, Amazon headlining another busy week for tech earnings. That conversation up next with Citigroup's Stuart Kaiser, who is constructive on growth equities and sees further upside in this equity market. Your opening bell is up next. Let's get your trading week started. About 20 seconds away from the opening bell. Equity futures positive here by 0.1% on the S&P. On the Nasdaq, what a week last week, encouraged by earnings from Meta, from Alphabet, up 2% on the Nasdaq 100. Right now, up by 0.08%. Going into a big earnings week. We'll talk about that a little bit later. Here's your opening bell. Switch to the board and get to the bond market. Yields on a 10-year slightly higher by a couple of basis points, in and around 4% on a 10-year yield right now at 396.88. In the FX market, stronger euro by 0.06%. The data out of Europe, put it this way, we've got some growth, great, a bit of economic growth out of Europe. The problem is core CPI is running at 5.5% and core is above headline inflation for the first time since 2021. ECB President Christine Lagarde's being vague, but she's got some problems, that's for sure. In the commodity market, positive by 0.7%. The rally continues for crude, $81 and about 15 cents, and heading towards the biggest monthly gain since early last year. 40 seconds into the session, we're positive here by 0.1% on the S&P 500. On the Nasdaq, up by something like 0.2%. One stock to watch at the open, Johnson & Johnson. Shares under pressure after a judge ruled against the company's latest efforts to limit its talc-related liabilities. J&J writing in a statement, quote, as the bankruptcy court urged in its decision, we'll continue working to pursue a resolution of the claims. Abby has more. Morning, Abby.
Good morning, John. And it looks like tens of thousands of cancer victims will be able to pursue their lawsuits that could total $15 billion. Now, this, of course, after that judge did dismiss a second attempt at the company to use one of their units' bankruptcy case to press those victims into a roughly $8.9 billion settlement. So that's a more than $6 billion difference. It's unlikely that they would succeed on appeal, many folks are saying. And the federal judge said an appeals court set a higher standard for bankruptcy than what the judge had considered when J&J first put LTL into bankruptcy. Wells Fargo said that the decision should not come as a surprise. Cantor Fitzgerald is seeing potential liabilities as being manageable. This stock, John, now down about 3% on the year, underperforming the S&P 500 by more than 20%, as there is certainly this overhang.
One to watch at the opening bout. Abby, thank you. Here's another. Turning to autos, Jefferies downgrading Ford to hold after the automaker announced delays in boosting its output. The analyst writes in this: the change in guidance is a setback for a group that's needed to address volatility in operating performance. We appreciate efforts in disclosure and accountability, but also note that there's no apparent change to their strategy. Katie Greifeld has more. Hey, Katie.
Hey, John. Well, you can really feel the emotion in this sell-side report because you had this Jefferies analyst writing that they're downgrading Ford to a hold with, quote, a heavy heart. Of course, this comes after Ford reported those worse than expected losses in their EV business. Remember, the company said last week that it expects to see losses from EVs hit $4.5 billion this year. That's up from a previous estimate of $3 billion. And CEO Jim Farley also said that pricing pressure has increased dramatically in just the past 60 days. Now, the company also said it's going to need another year to meet its annual production rate target of 600,000 EVs. And while Jefferies said that the company's decision to slow the pace of unprofitable EV sales to safeguard its returns is a sensible decision, it's a setback nonetheless. And hopefully Ford gets back on track for the sake of this analyst. You take a look at shares right now, currently off by about 2.2%.
Katie, is that how you downgrade and maintain access to management
there you
at
go.
the same time? Is that by design? Maybe. Katie, thank you. I think we all hate that, don't we? Let's stick with the autos. Jefferies also downgrading Carvana, cutting its rating to underperform and writing this. This one less emotional. Fasten your seatbelt. There's still a rough road ahead. Transitory tailwinds are inflating near-term profitability, which will start abating in the coming quarters. Jefferies becoming the fourth brokerage to turn bearish on this stock this month alone. Elsewhere, let's get back to earnings. SoFi Technologies topping analyst estimates and boosting its outlook. The CEO saying this: as a result of this growth in high-quality deposits, we have benefited from a lower cost of funding for our loans. Shanali has more. Hey, Shanali.
Hey, hey, John. I'm Shanali. I'm very sorry. When you look at SoFi, for example, you went from the banks to the non-banks and the neobanks, and SoFi, which bought a bank, and they are finding now a big boon from that. Net interest income doubled in the period, and then you also have a stock that has more than doubled this year, also seeing gains this morning after you see SoFi and its former Goldman CEO, Anthony Noto, now diving into the consumer, diversifying away from student loans into different kinds of banking products. And he has raised his guidance multiple times over the past year. This is a stock that took a serious beating last year, really on the rebound this year. Among the savings accounts that you see out there, they do offer one of the best rates, more than 4.4% on a savings account. So they're bringing in those deposits. They are showing that even then the business model does work as margins are improving, and again, raising their guidance.
Abby called me Joe last week. Shanali, don't worry. I can be Shanali today. Thank you, Shanali. Thanks to Bloomberg's Shanali there. Tune in for the SoFi CEO at 12:30 p.m. Eastern Time on Bloomberg Technology. Look out for that conversation a little bit later. And finally, shares of Adobe are rallying at the opening bout. Morgan Stanley upgrading the stock to overweight with a street high 660 price target. The analyst writes in this: greater clarity on AI-enabled products and its roadmap increase our confidence in re-accelerating the cloud growth engine. Ed has more. Morning, Ed.
Yeah, good morning, Jonathan. Adobe's given up some of its early gains in the session, but still higher by 2.7%. That 660 price target call from analyst Keith Weiss assumes a 25% gain in the shares over the next 12 months or so. Morgan Stanley also lifting its longer-term EPS and revenue growth expectations. It's interesting because in the note, they admit that Adobe was kind of late to the party when it comes to the generative AI play. But what we got in June was a sense of the strategy. It is a subscription-based service for broadly consumers, a flat rate for business customers, but also being able to make money on the copyright services relating to image generation from generative AI is an example. That street high price target of $660 a share, if those gains are to materialize over the next 12 months, it would take Adobe pretty close to the record high it hit in 2021, $688.37 a share. Just a reminder that this is a company that kind of reports later in the season, so we won't hear from them in a while, but we did get that outlook update for both full year revenue and profit in June when they outlined strategy. The average 12-month analyst price target on this stock, $555.70 a share, right now up by almost 3%, trading at its highest level since January of 2022.
Forget Adobe. Let's get to the two big players Thursday. Amazon, Apple. What's the street looking for?
Yeah, Amazon, you know, it's a continuation of the Andy Jassy story, undoing the pandemic era investment, going back to the cash cow profit of AWS, but you'll see the news this morning on them being very aggressive in delivery and fulfillment times. And then Apple, iPhone is king. You know, we've reiterated this time and time again. The Vision Pro is very distant from being meaningfully revenue generating. Tim Cook always hesitant to be an economist on the call, so it lives and dies by the performance of iPhone globally. And then also some surprises potentially in Mac in markets like China, where the consumer seems willing to spend on that premium tier, especially for products that are new to that market.
Huge week ahead for Bloomberg Technology and the team. Ed, thank you, sir. Ed Ludlow, Caroline Hyde, midday, Bloomberg Technology. Do not miss that. And then, of course, later this week is the big one after the close. Remain in the team will break that down for you. When we get earnings on Thursday after the bow from Apple and from Amazon. Citi Stuart Kaiser making a case for tech stocks, writing this. The prospect for softer data into year-end is a key reason we see a cyclical rotation as unsustainable. We keep tech and growth stocks as a core equity exposure. We maintain a tactical upside bias. Stuart Kaiser joins us now. Stu, wonderful to catch up with you, buddy, as always. Let's just start with the upside briefly. What underpins that further upside from your perspective?
Hey, Jonathan, good to see you again. I would say it's, pretty basic, actually. You've had, significant positive surprise in U.S. economic data. The Fed seems comfortable backing off a little bit. Inflation's been easing. Last print was pretty friendly, and our economists expect that to continue for the next couple of months. So I think you put all those three things together, and it's just a good path for risk assets to continue to move higher. So we remain, tactically bullish on the markets.
To capture that upside, though, you're thinking about growth equities, big tech players. You're not thinking about cyclicals, Stuart. What separates you from, I would say, the pack that is increasingly becoming consensus?
Look, I think our view on tech is exactly what you've seen this earnings season, which is earnings growth is still relatively scarce. If you look at the drivers of performance this year, EPS momentum or positive revisions to consensus numbers have been a key driver of returns of the leadership of the market, and we think that continues. We're not necessarily negative on cyclicals. I think through the options market, you can get exposure to banks or to energy to that upside trade just in case you need it. But I think the core view remains tech and growth, because I think, growth is still scarce both in the U.S. and globally, and it's large cap U.S. equities which have that growth. So, we're not ready to pull the cord on that one quite yet.
As you know, lots of people talking about the weightings of the NASDAQ 100 and how that's going to shift. 11% of the NASDAQ 100 is still Apple. More than 5% of it is Amazon. You add up the two, and you've got some pretty big weightings from two names, Stuart Kaiser. Some people complain about that narrow leadership, that dominance, unsustainable. Are you taking a different view on things?
Jonathan, it's just not something we're that stressed out about. I mean, I would agree. Obviously, there's a lot of concentration in U.S. equity markets now. And more importantly, I think the leadership has been concentrated in a relatively small number of stocks. But if you look back through history, this isn't, too abnormal. There are generally, it's generally either a sector or a small number of stocks who are contributing, the bulk of the returns in a given year. This year it might be a little more concentrated in a small number of stocks, but I don't think this is, just completely out of the ordinary historically. It's kind of the beauty of U.S. equity indexes, right? That you're continually dynamically rebalancing into the best and brightest companies in the world. So, yeah, it's an issue. I think it's on a lot of people's radar, but it's just not something right now that's going to make us change our tune on that part of the market. I would say it's a similar argument to valuation. It's potential energy. It's something you need to worry about from a risk-reward perspective, but you need a catalyst to release that energy in either the upside or downside direction. And currently, we just don't see a driver or a specific event that's going to release release that in a negative way. So, yeah, look, it's on our mind. We get asked a lot about by clients, so of course we have to think about it. But again, I don't think historically it's that as abnormal as people want to make it out to be.
Just going through the calendar for the week ahead, Stuart, that'll be the focus for Thursday after the bow. Those numbers come through, Apple, Amazon. Friday morning, payrolls, 8:30 Eastern time, a number that we used to see a lot of, the estimate, 200,000. Stuart, do you think the data itself is becoming less volatile? And I noticed in your research, could you walk us through the relationship between that and the volatility in the market?
Yeah, for sure. I mean, I think both the realized economic data, whether that's payrolls or, in this case, more importantly, inflation, has obviously come down considerably. And then if you also just look at the volatility of real yields, of nominal yields, of federal funds, the volatility of all those metrics has declined. And if you look historically, when those macro elements are very volatile, then it's going to spill over into equity markets. And I think, the reverse of that is what we've seen this year, is realized economic data has become less volatile. The macroeconomic indicators have become less volatile. And that's allowed equity markets to become more investable in our view. And we've touched on this a couple of times, that if you trim the tail risk and you reduce the range of outcomes to something that's a little bit more manageable, effectively add clarity to the market, then equity markets are going to typically perform positively. And we think that is happening in the background, and we expect it to continue to happen going forward.
Do you find that supports risk just in general, or does it favor one part of the market more than others?
I think it supports risk in general. I mean, I think it supports credit markets, supports commodity markets, and definitely supports equity markets. But equity markets in particular, what you're looking for is clarity or predictability, right? Equity markets can work with an inflation rate of 4 or 5%. They can work at an interest rate of 4 or 5% historically. Once the market adjusts to that expectation and can invest in it appropriately. And I think the issue last year was, yes, the change, the change in the level of yields, but more importantly, just the uncertainty around it. Last year you're talking about 75 basis points, 100 basis points, potential hikes at a given meeting. Now the question is, are we skipping a meeting? Will you get an incremental 25 or 50 basis points over the next 3 months, let's say? And I just think that's a very big difference in investment environment, relative to last year.
Enjoyed the research yesterday evening. Thanks again, Stuart. Thanks for being with us. Stuart Kaiser there at Citi, looking for further upside here in the equity market, going into big earnings later this week. Your market at the moment, about 13 minutes into the session, equities positive by 0.2% on the S&P 500. Earnings on Thursday, data on Friday. Coming up, trucking giant Yellow shutting down after nearly 100 years in business.
I am pretty worried that this economy is going to slow meaningfully in the coming quarters. Everybody, of course, would like to have a soft landing and not have job loss and have this continue. But the initial conditions are a little tough.
The outlook for jobs in America, up next.
Overall, I think that the inflation outlook is quite positive, that it should be slowly diminishing from here. But again, we've just continued to be surprised by the dynamics of this reopening economy, and so we can't prejudge it. We have to let the data actually guide us.
Neil Kashkari there of the Minneapolis Federal Reserve going into their next decision on September 20th, I believe. That's where thousands of jobs at stake as US trucking giant Yellow tells workers it's shutting down, putting roughly 30,000 jobs in jeopardy as trucking companies try to balance slowing demand and rising wages. The job loss is coming on the heels of the union winning large pay increases from UPS and another big payrolls report coming on Friday. Let's get your team coverage. Bloomberg's Anne-Marie in DC, Michael McKee here in New York. AMH, the reaction from Washington to that dispute last week was somewhat of a victory lap. This morning, I imagine anything but.
No, it's not a victory lap, although we did hear from Jared Bernstein, the chair of the White House's Council on Economic Advisors, talking to CNBC. He said this is more about Yellow and less about a market indicator for the economy. And he did repeat what the president likes to say a lot, Jonathan, and that's the fact that he says he's the most pro-union labor president in modern history. The optics, though, could be muddled for the president, given the fact that Yellow reached out at the end of June to the president in a letter, and this is what the company had to say. Despite support from your administration, these efforts have proven unsuccessful at getting both sides to the table to discuss a way forward. The company blamed union intransigence, Jonathan, that Yellow's business plan has been frozen. There's another political aspect to this as well, Jonathan. It might not bode well for the former Trump administration. And Trump, you know himself, is a candidate and potential nominee for the 2024 election. Under his administration, Yellow got a $700 million loan on a national security designation that now Congress is saying Treasury and the Defense Department made missteps in that designation and giving that loan.
Mike McKee, are we learning loads about Yellow or a fair bit about the labour market? The more I read about Yellow, the more I believe it might be the former and not the latter.
Well, I think you're right, John. Yellow does have some unique problems that led to its demise, although certainly the labor issue is a big one as people try to get their money back from the inflation of the last couple of years. But here's the good news for at least the U.S. economy. There are a lot of trucking jobs open, over 600,000 according to the last JOLTS report. We get another one on Wednesday. And if that's the case, then the 30,000 people who are losing their jobs should be able to get new jobs fairly easily. So this might fade as a political issue. The UPS strike would have been much worse had they not settled, because we were talking hundreds of thousands of people there. But the Yellow company is what they call a less than truckload company, where you don't have to fill the whole truck if you're a shipper. And there are a lot of others in that space. And the feeling is they can pick up the overall load, especially since less than truckload loads have started to go down. Yellow had gotten into a lot of debt problems because it bought a number of other companies, especially some that were unionized, and their wages were higher than the rest of the industry, and their overall costs were higher than the rest of the industry. And when the Teamsters came to them and said it's time to give us a raise, it basically boils down to they didn't have the money.
Mike, I'm looking ahead to the data on Friday. Payroll still looks pretty robust, 200K the estimate. Unemployment expected to stay at something like 3.5%. Is that widely, more broadly, the expectation?
That's the broad expectation. The real focus has been on the number of jobs created and the fact that the market hopes is slowing, although we've most months come in ahead of what the market thinks. The unemployment rate, 3.6%. Supposed to be unchanged. That doesn't match up with what the Fed has forecast. So it will be an interesting data point, but we do have another jobs report coming up before the next Fed meeting, so that will tell us more about what the Fed might do.
2 jobs reports and 2 CPI reports between the last Fed meeting and the next one. AMH, thank you as always to Mike McKee as well. Busy week for Mike McKee. Anne-Marie hoping to take August off, but ultimately you can't get away from the legal issues at the moment down in Washington, and there is a GOP debate coming up at the back end of August, so the political campaigns pick up a little bit too. Your equity market more broadly on the S&P 500 positive by 0.2%. Let's lift the lid on the index and get you some sector price action. Here's Abby.
Even though that gain is very small, John, we have most S&P 500 sectors trading higher, so lots of breadth on the day. 10 of 11 S&P 500 sectors higher, led by energy, up 1.8%. We have oil firmly above $80 a barrel. Some analysts expecting it to go sharply higher than utilities. Real estate are also near the top. Interesting, because yields aren't doing all that much. On bottom, healthcare being weighed on by J&J. Now, the month of July, John, it's the second month in a row that all 11 S&P 500 sectors are higher, at least right now. Real estate is the worst, down up 1%, but it looks like that will be the case again, signaling breadth. As for some of the top, communication services up 7%. You also have that energy sector at this point taking out communication services for the top spot, and then financials and materials. So the breadth that everybody's wanted all year long, it's starting to creep in a serious way, John.
We're seeing it happen, Abby, that's for sure, after the dominance of big tech for most of this year, that broadening out that the equity market bulls were hoping for, wishing for, and the people who've been trapped in money market funds and pouring into the equity market are perhaps looking for. It's a quiet start to the week stateside. It promises to pick up as the week progresses. Your trading diary is up next. 25 minutes into the session, advancing by 0.1% on the S&P 500, pulling back just a little bit on the Nasdaq 100 by, let's call it, 0.1%, following a really decent week of gains on the Nasdaq just last week, encouraged by the numbers from Alphabet, Google, from Meta, of course, Facebook, and looking ahead to the results from the likes of Apple and Amazon later on in the week, after the bell on Thursday. That's the equity price action. Let's get to the trading diary. Packed week coming up. Earnings from Caterpillar, Uber coming tomorrow, plus the JOLTS report and ISM manufacturing data. We'll get Qualcomm earnings on Wednesday ahead of Apple and Amazon on Thursday, plus a Bank of England rate decision as well. And finally, the US payrolls report to round the week out on Friday morning at 8:30 Eastern time. The estimates so far, the median estimate in our survey, and bear in mind that's a moving target as more estimates start to change and more estimates start to come in. The estimate at the moment, 200,000, and unemployment expected to remain around 3.5%. Much to look forward to. Thank you for choosing Bloomberg TV and good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.